interviewing the leading private equity executives and unlocking the secrets of success. Welcome to the Private Equity Podcast with Alex Rawlings.
Hello, everybody, and welcome back to the Private Equity Podcast. We are absolutely dedicated to bringing you value that you can action into your PE firm or portfolio company with every podcast that we do. So this is a warning. Have a pen ready here. This is going to be one for saving you both time and money. Joining us today is James Lee, partner at Proskauer. He works within the M&A and private equity practice, working mostly with industrial, technology, and healthcare companies. Welcome, and thank you very much for sharing your insights into the private equity industry today, James.
Well, I really appreciate the opportunity. Thank you again.
Perfect. For those who are not familiar with yourself, James, can you give us a 60 to 90-second breakdown of you and your firm, please?
Yeah, sure. Maybe I'll start with the firm. Proskauer is a full-service law firm, and one of our ethos is we're built for asset managers. I think we have one of the larger fund practices in the country, also internationally. Have a very strong technology group here as well. And one of the other kind of big kind of pillars is our labor group and benefits group, which is considered one of the nation leading practices. And I guess kind of what we're also known for is that we happen to represent a number of the major sports leagues in the United States, most notably the NBA. So that's kind of how people know Proskauer. Specifically in our private equity group here, we're known to represent sponsors both on the equity side, and also we have a quite strong private credit group practice, which is also probably the largest private credit group practice internationally. Well, a little bit about myself. What I do is I represent 100% private equity sponsors. My practice breaks down to about 75%, 25%, 75% doing leverage buyouts, change of control transactions. And then the other 25% is on growth equity investments. In growth equity investments, we're talking about in technology space, SaaS, consumer products, the Internet of Things, wearables, and things of that nature. And then also a biotech. My clients are, they invest in a little bit later stages. So we're not talking VC, we're talking more in Series B, C rounds when, some revenues has been starting to show. So that's really been, but I really think the private equity market in itself, I think people that just did change of control transactions before are now looking into deploy capital because of the extensive dry powder that they've accumulated over the years now to find other opportunities here. And they're finding that in the growth equity space to join up with other, consortiums here to kind of support a company in their growth as another avenue. So it's really been exciting. I've been very fortunate to be growing up in my career when this kind of growth equity and private equity, growth equity, and leverage buyout hybrid method models have been really growing up. So been very have had a very unique experience to kind of grow with it.
Yeah, it's certainly a very busy time. I know we've had obviously COVID, which we won't bring up too much because everyone's sick of hearing about it. But we've seen a lot of the amount of raises, and even during the last year and a half or so, even raising capital during difficult economic times is just a testament to the amount of return that obviously investors and the excitement of what's happening with private equity, and it's historic growth and continued growth as a alternative asset class becoming a leading asset class for investors.
That's right.
So I know obviously, as you mentioned, you work a lot with, if not all, with private equity firms and their portfolio companies. But what one mistake do you see either PE firms or portfolio companies making from your perspective?
Well, I would say more in the mistake part, but I think there is a kind of a mad dash to get the asset up for sale, right? And I'm going to talk from a sale perspective. You got the bankers going and everyone going here, but I think there needs to be some thought process. I think and I've also applied that with my clients, is getting sale ready, right? What does that involve, right? It's making sure all your corporate governance docs are in order. But I think more so than ever, I think one of the areas in which I find that there's been a lot of what's the right word here to use? Waste, is in the sense that we're at a stage in the private equity deal making space, whether it's a widget or a service. I think we could start from that, where we clearly know what are the kind of the due diligence items one would want to see, right? Instead of a buyer giving you a kitchen sink due diligence request list, which then makes it inefficient for the buyers to spend money on things of that nature. There could be more upfront work on basically taking a stock due diligence request list and setting up the data room in such a way that information that one would want, that they know that people would want to see, has already been populated, right? Because one of the things that kind of pops up is that when we go through documents and such, there's some things they could have fixed easily, but now it's become an issue. Now it's become added to an issues list or things of whatnot. For example, getting your company house records in order. You know what I mean? In the U.S., getting your certificates of good standing. Just things of that nature. The planning that can be taken into it really saves you a lot of cost, as opposed to having to deal with this issue later. In addition, if there are any disputes with material customers that you might need to disclose, and from that space, you might want to get in front of that and just to really kind of put something into the data room, before it kind of blows up to something bigger. This is nothing more than an ordinary course, customary, customer complaint that we receive from customers. You know what I mean? So what I'm really trying to say here on the sell side is to be proactive and trying to get in front of the issues that that are going to be propped up. And I really think it's the advice of the lawyers here, because at the end of the day, I think, lawyers get a lot of bad flack saying, how can you still be doing diligence right now? We spend all this money on diligence, right? And one of the answers that I really get back to them, because, at Proskauer, we use a lot of techniques here, and we use a lot of software to really dissect where has the time been spent. And I'm able to show them it's diligence, but even within the diligence, what part of the diligence process is really, generated most of the fees. And you would be shocked to know that, while it's always going to be the majority of the case that people are reviewing the documents, and that takes some time to do the analysis, but there is about 25 to 30%, and this has been consistent across my last 7 deals when I've done the math on this, when I get my report at the end, on the minutiae of just going back and forth, requesting a document and then filling out an Excel spreadsheet saying it's in this room, it's in this here, it's here, not applicable, and that exchange of going back and forth, that has to be, and I know there is a better way to go about doing this, right? If there's an industry standard here that we can say, for a particular company of this type, these are the type of things you should really get into your data room. And, the people, if there's a reason why you're not sharing it at that point, understandable, right? Very sensitive customer contracts. It's, for example, if we're representing a strategic, there are some things you might want to leave behind, right? But let's be honest, that is like 5% of what the diligence materials is. At the end of the day, we're just really trying to check the box. And I just, and to frame it, I wouldn't say it's a mistake. I think people are, really trying to, do their best to get, to make the process efficient as possible. But I think there's been, in the last few years, less and less of people preparing for a sale, right? And it really just takes, a couple of meetings, first with the board to understand if there's anything out there that we should be knowing about. And two, really getting maybe a couple of junior associates to kind of go through some of your documents and really clean these things up in such a way. That only makes everything a lot more efficient. It makes negotiations more efficient. It takes away a lot of the noise and the underbrush, because in every diligence exercise, there is going to be a point in time where there's going to be a level of frustration. And the frustration comes from 2 parts. The frustration comes from, number one, the operators have a day job. They're still running a company. And you're pulling them away from doing that, to get all this type of information. Well, if you had given this type of information saying, hey, we were going to probably need to do all this, they probably can bring, they don't even have to bring as many people into the tent. In the ordinary course, they can ask one of their direct reports, hey, can you pull me X, Y, and Z, right? Without having to, get so many people under the tent. It really seems more ordinary course. I have found when we have done that, we've been able to save a lot more cost. And that 20-30%, when you tack it to what a due diligence bill could look like, and they've been going up from what I've seen. And I'll kind of explain why. It's because, it's an area in which I know we can cut out the fat, right? If there's some upfront work. It's really driven diligence. The diligence cost has also gone up because of the rep and warranty insurance policies that everybody is obtaining, right? People don't go in. I don't want to speak for the whole industry. My clients do not go into a situation thinking that they're going to be using this rep and warranty policy, right? So there's been a heightened level of diligence. We do go further into things. I think all that stuff can be kind of taken care of in the upfront. And the other aspect of this, and maybe we'll speak a little bit later of this, is ESG, concepts that have really been, being starting to be baked into the diligence process. One thing I like to say here is that many of the questions that we're asking around ESG, we've been asking for a really long time, right? I think the focus of where, when, and how they're asked has really changed, but we've definitely been asking these questions, but not to the degree that we really need to in order to make a very good assessment. I'd like to give a quick example that came up recently. We're looking at these margins on a particular company, and we asked them a simple question. Can you give us a brief description of your supply chain and who you guys source from and things of that nature? And could you provide a list of countries? There was some hesitation, and we finally did get the answers. And we did find there were maybe 2 countries that we were probably not comfortable with in which they were sourcing things. Dug a little deeper. I won't go into the real specifics. We walked away from the deal. My clients did. So the diligence process can be a lot more efficient, but now that we're applying a lot more heightened exercise around it, right? Because of rep and warranty and because of ESG concerns, we should only be looking to further reduce the administrative burden because the substantive aspects have only increased.
No, it all makes sense. So you mentioned obviously ESG. You mentioned obviously we'll come into that. So let's dive into that right now. I know that obviously it's a particularly passionate area for yourself, and you kind of lead that within the division within your firm. What involvement you had in it, and also I think ESG is kind of a bit of everyone kind of gets it, but then there's also a lot of mystery around it. Okay, so what does that mean for certain businesses, and what does that mean on an M&A and DD side? So if you could explain kind of how that fits, but also what your recommendations would be for businesses to as you said, you've been talking about it for a long time, but maybe it's not been as well implemented by the PE firms and their portfolio companies.
Yeah, no, it really has become a passion of mine because I think we're now coming to the point of some social responsibility, and as we've been going through here, and the facts kind of, the results kind of show for themselves in a lot of aspects. You can try to, do good and try to do good in all these different types of ESG related components and still, turn profits and things. Also kind of, what kind of things are you investing into, what I mean? The people that you're going, in terms of maybe I'll start from a deal perspective here. From a deal perspective, we look at things around human capital, right? At a more heightened point, in terms of recruiting employees. What is your employee base? What is the satisfaction? How are you improving their communities? But then also, I think, one aspect I think that was maybe not as heavily, diligence is, we looked at the target, right? And just the target itself. We really didn't do as good a job in the past because it wasn't such a focus is, what is that target's impact around the community that it's in? How is it helping the community, right? Is it providing other job opportunities? Is it providing for career developments and things of that nature? There are many towns and cities across the world to this day, where one manufacturing plant really does support that particular town. You know what I mean? I would say, even over in the pond here, I've been to Sheffield 4 or 5 times now. And in Sheffield, I mean, without some of those factories there, I don't know if Sheffield, would be as private as it is today.
Absolutely.
So there are definitely, concerns, that you need to diligence. For me, I think, from a diligence perspective, what we have done, it was that we have prioritized, and like I said before, these are questions that we've asked before, but they were toward the tail end, right? We've reversed the orders of a number of these things. I gave you the example about the supply chain. We do a little more diligence on supply chain stuff. But one of the things that, this was told to me yesterday and on a call yesterday, and I think it was so apropos, She mentioned a commercial, maybe it came out 4 or 5 years ago, and it's a bunch of people that have their head stuck in the sand. And all of a sudden, this new type of product comes out, and everybody lifts their hands up, lifts their head out of the sand, and they all just kind of start running towards that goal, and then they fall off a cliff. Okay. So I'm forgetting I think it was Athena. It's Athena commercial. That's kind of where we are right now. Just to give a real blunt kind of response to this, is that there have been firms, private equity firms, that have been out there doing this for 10 to 15 years. You could have called it something different, social responsibility, climate responsibility, and now we've kind of packaged it up into, this very misnomer ESG. But one of the things that we do not have is, by way of example, we've now started to see, and especially in the UK and in Europe, in your side of the pond over there, an earlier adoption of inserting ESG metrics into credit agreements, right? So if you meet some of these 3 criteria, and I'll just give you by way of example without any referencing client names, if you have, X% of females and minorities that serve on your board, if you have X amount of people that have been engaged in certain programs, to further their development, things of that nature. If you achieve all these things, then you'll get basically half a point cut here, 500 basis points one way or the other, and we started to see that a lot more. I think when talking to my UK colleagues about 12 to 18 months ago, it was really kind of the big large cap people that did that and what the metrics are. But you're now seeing it move down to the middle market on the lending space in the UK and Europe. But one needs to really question 2 things. One, in the middle market, you're seeing a lot more self-certification. Okay. They're certifying like any compliance certificate, our covenants are in order, X, Y, and Z, and we have complied with this ESG metric. We have, out of our 8-person board, we have 5 minorities or, females or, other minorities and things. We have X amount of different employees in different programs, and we've hit all the 3 ESG targets, right? But let's take a step back. One, who's to say those are the actual metrics that are the right metrics, right? And that's what I'm kind of talking about, in the sense that everybody's lifted their head up from the sand, right? And while other people have been doing this for 10, 15 years, now everybody's just rushing to get to something, right? And what I'm fearful about, and what I do see happening until there's some stabilization of this, is that people just kind of start falling off the cliff, right? So there's a certain danger of this, that, while all these concepts and everybody wants to do good, I'm really looking for regulators to really take a larger stance here. You know what I mean? I know in Europe, in the UK, they've already started this process and it's already coming to adoption.
Yeah, I think it's just come out actually. Yeah.
Yeah, exactly. And the US here, the SEC is taking a look, kind of following to kind of see what's happening. The SEC has started, some initiatives, to start these conversations, but, there really hasn't been an across the board kind of, what is determined to be the right ESG metrics, what are the things that we're really trying to do here. The other part about this and the other side of this is who's doing the certification, right? I'd said in the middle market space, people are doing a lot of self-certification, and some of the metrics I'm seeing are a little bit more wishy-washy, right? But in the large cap ones, who's doing the certification? They're hiring people that are these consultants, right? And for what I've seen in the past is that, if you don't hire us as a consultant, we give you a rating of a C. But if you do hire us, we can help you, get, and all of a sudden my rating is a B.
Yeah.
Right. So there's, from the investors and from the lender's perspective, and from the borrower's perspective, is how do we trust the certifications? You know what I mean? Because they do have a meaningful impact. It may have a meaningful impact on if you meet your compliance or thing or not. And then there's just the added cost to it. Like I said, in the big cap, large cap market, they have the funds, right? It's a big, large public company. This is something that's important to them. They have the coffers. But if you're in the middle market space, you may not have all these different type of advantages and access to capital in order to spend all this money doing it. So there's I think there needs to be some point where there's going to be some stabilization. And another point that when I was speaking to someone yesterday, I want to credit them because it wasn't my idea, in the sense that the kind of rate changes that you get for complying, is it really moving the needle of the cost of that debt? If you're getting a 50 basis point shift on your interest rate or something to that effect, did that really move the needle on your model? Now, in other words, what I'm really trying to say is that certain metric that you insert, was it really inserted for the purpose to state on a press release that we have good ESG metrics incorporated in here? Or is the fact that, is the metric that we inserted not meaningful at all, right? So, that's one thing. Again, we're in the very early stages of this in the credit market space regarding ESG, where we're seeing, people get rewarded, right, for meeting certain ESG targets. But, another thing that I was speaking to someone yesterday said, and I agree with them, is the fact that what I see in the future is the fact that it's going to be a baseline that you have to meet these ESG metrics. And if you don't, it's going to be more punitive, right? Your interest rate is going to get higher and such, because, it's hard for me to imagine that the banks and other lenders trying to lose that much yield over a period of time, right? So I do think so. So it's a long way of saying, just to give you an example, of kind of how ESG is incorporated into the private equity space. It's kind of, we're really seeing in the credit market space, but also more so than that, we're seeing pressure from LPs of private equity funds saying, hey, this is important to us. You need to sign up to this initiative and go carbon free by 2050. You know what I mean? But at the end of the day, you look at these aspirational things at 2050. Hopefully I'm around, hopefully you're around too, you know what I mean? But, the real incentives to things, and really I think to drive all these things, if we start really having kind of right now, start thinking through, what kind of impact could we be making now, right? Instead of just trying to, and again, this is, I'm not trying to be unfair, because I do think that a lot of big, corporate, BlackRock, Carlyle, with their credit lines that they come out here in the U.S., I know there's a meaningful impact on what they do, and in terms of that, but I do fear that it's, maybe we're in a stage in which people are saying, hey, we believe in ESG, what I mean? Look what we've done so far. We've given these type of, these ratchets in our credit agreements, to help support that, but for people that really, like myself, really, believe in the concepts and the benefits of supporting ESG concepts and principles and guidelines, really start to kind of question, where we are right now, and to see 5-10 years from now, how we've developed, and I think I've given you one of my predictions is the fact that I think ESG compliance on a certain standardized metric, will become the baseline. And then it'll be more of a consequence and punitive if you don't meet those things, because private credit groups, as I said, Proskauer is one of the larger private credit practices internationally. It's to say, how is it going to start impacting the private credit market and the bank lender market and things of that nature. But it is something that's extremely important, but then the other side of that too is things that have come out, and I think in the news today, there's going to be over 1,000 different companies that are going to send climate change reports regarding their companies to the SEC. You also saw the news in the other side, Coca-Cola talking about their diversity programs and how that impacted their stock prices. So no good deed goes unpunished, I think, as one would say, right? You're trying to do good, but there's some liability that impacts to that, and kind of the fiduciary duties that you may owe to one person to your stockholders, right? As opposed to maybe this is the general good. There's going to be a lot of these balances that we're going to have to work through. And that's the fear that I have when I've talked about my example of people finally taking their head out of the sand, of realizing this is extremely important, but without much thought. And I know they're hiring advisors, but I do question the advisors themselves. right? I mean, they didn't really start out the right way. I mean, you needed to separate the rating agency and then your consulting arm to it, because it just doesn't seem right.
Yeah, get that balance. It's difficult when any new regulations come in. It's can be loosely related. We had a big European GDPR type process that came in of data protection, and again, I don't think they've particularly delivered that well, because there's a lot of complexity to it. And then suddenly all these GDPR experts came out of nowhere who were all advising, and you need to do this and you need to do that. And it kind of came around a scaremongering process. And then realistically, it all kind of died down a month or so later. And there wasn't a lot of change there. But I think if there's there's that kind of carrot and stick type mode at the moment. I think we're at the carrot basis. If you meet these metrics, then your interest percentage will change. And the stick method it changes for the worse if you're not hitting it. So it's kind of creating that kind of standard as you've communicated there. So that's perfect, and that's one of the better examples of what I regard as ESG. Because I think ESG falls into the kind of ESG, sustainability, and everything all kind of gets convoluted into one, and that really separates it away from what I regards to sustainability investing. Albeit it all comes into that, but that's a different kind of topic in itself. So it's good to hear about what kind of should be happening from an ESG perspective, and firms become a lot more aware of that. You mentioned quite a bit, and we spoke prior to this with regards to your passion for that kind of process improvement and supporting private equity firms. How would you mentioned a few bits already, but how would you see, or what kind of in recommendations would you make to private equity investors to maybe improve their deal process and make that more efficient?
Yeah, and I thought about this too, and after I spoke with you, and there's just two things of mine, and this is again me, shouting on top of my own little soapbox, so thanks for the opportunity to speak on this. I guess first off, and I think maybe other practitioners in my space, I might be getting some nasty grams, but we're at a stage where, I've been doing this 18 years, and I've seen the maturations of purchase agreements from the heydays of private equity to kind of where we are right now. Again, kind of like private equity is really booming again. And if you take a purchase agreement from then and take a purchase agreement from now, there's been some material differences, in terms of where the market has moved. But I would say in the last, since after the 2008 crisis, right, we've seen now, and also from the 2008 crisis, there was also the advent and the rise of rep and warranty insurance. And the reason I'm going to mention those two things together is really it's kind of like setting the backdrop for what I'm about to say. There needs to be, I think, at this point, some standardization of purchase agreements, right? We've seen it work well in the context of growth equity, what they call the NVCA forms here in the US. And it's really kind of established the baseline of kind of, what people deem to be market or not. And I know it's going to be a harder task on the M&A side, right? Because at the end, in the beginning, when the NVCA was formed, there were maybe 10 to 12 of the law firms that were really into it, right? One in Silicon Valley, but Boston, some here in New York, like Proskauer and Goodwin. But at the very least, is one thing that I would like to kind of put out there is the rep and warranty, the sets of rep and warranties, right? You go through this, and everyone spends a ton of time, marking up these rep and warranties because it's a rep and warranty deal, right? But then we also know on the end, I've done, maybe about, I think last count was 57 different policies, and what's going to be excluded, right? What reps are going to be modified in some different way, things of that nature, and that wastes a lot of time. One of the things that I would love to propose, and I love to propose some other practitioners out there, and I know there's been other attempts to do this, because when I started, there was like the model SPA, which no one really refers to anymore because it's been so outdated. But I think it's time again, for us to really start thinking about, because the fact of the matter is, and anyone that's spoken to me in the past and that's ever heard me on a pitch as well too, this will resonate with them. A large portion of what we do is become commoditized. Let's just own it. Let's just own that. And really start, providing the value add in other areas and where we can provide the value add. So, one thing I would highly suggest is there should be a standardized set of reps, right? Let's not argue about reps you're not going to give me or not, or things of that nature, right? And some people, I get a lot of pushback on, anti-money laundering, reps. Well, there's no way I'm signing this document without one, considering the heightened risk around that. It's a red flag right now, and especially here in the U.S., like anti-bribery, FCPA. I don't care what company you're in. If you're doing business across, if you're leaving the States and you're in a foreign country, those are the kind of things that are going to be important to me. I shouldn't have to argue with somebody to incorporate those reps, right? And that right there is time that's wasted, right? But then even in itself, I think we can both agree this is one area that is a heightened risk. So, with you inserting a knowledge qualifier, materiality qualifier, and then kind of really watering down this rep, you just didn't give me the rep. Let's all just come to an agreement. This is the rep that we need. This is the rep we need, right? And let's not touch that, right? So, I do fully appreciate there's going to be, for example, in the mid-to contracts rep, right? If it's a company that doesn't have a lot of contracts, it's going to be a different rep. You know what I mean? But there should be some standardization across some of the kind of the larger ones. Let's all just be honest here and say, these are the set of reps that we're going to be looking for. This is the language they're going to be looking for. There's two things that come out of that. One, it saves the client money because negotiating reps and warranties, really at the end of the day, it's either you can make the rep or you can't make the rep, right? If you can't make one of these standardized reps, then it goes into then it leads to that question faster for our business people to understand, how do we address this? They can't make this rep. So now it's a liability that we're going to have to either assume or address through purchase price reduction or specific indemnity. So it brings to light these type of issues much sooner in a deal, right? And that goes to momentum of a deal. Momentum of a deal is extremely important. If you have things that come up a little bit later, it puts such a slow drag on it. And there's been so much deal fatigue at that point where that issue is not treated as, as it should be. It's like you're pulling teeth for something that you should be getting. Like you have not been paying your employees taxes. I don't know why I'm arguing about this with you, but it came up later. I get it, but I'm arguing with you about this and how this should be factored in. So, if you have these standardized reps and they can tell you right away which ones they can and can't make, it really brings to forefront the issues a lot quicker. The second thing is this, and this is another cost-saving thing. I've had a number of conversations with underwriters themselves directly in the US and in the UK. And if there really was a standardized set of reps, they are able to then, do the analysis, say, which ones have we really been paying out on, right? And I think the most notable one is the financial statements rep. You know what I mean? So if that is the case, and all the reps are generally the same, the pricing on all these things on rep and warranty insurance should go down, right? So now you save your client costs in terms of the bill. Now you save your client's costs on the premium on the rep and warranty insurance. So all these other things do add up, right? You know what I mean? One of the worst conversations you want to have with your client is, why is the bill so high? Personally for me, I give updates every week, that's to avoid that conversation, but I have to say in other situations, I may not have been so lucky, but really analyzing our bills the way that I've been doing for the last 2 years in a very methodical way. And we run it through different programs and I get different graphs and things of that nature. That's where I really saw some of the stuff, right? Where can we take out some of this fat? And if you did, are you saving $1 million? No, but I think you're saving, upwards of $500,000, right, on some of these things. And you can really get to a point where you could have a lot more certainty to what the cost of a deal would be, right? Because one of the things that a lot of lawyers will say, I don't know how diligence is going to go, right? This is my quote, but it's really dependent upon the other side to produce the information, yada, 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 and they come back and forth and do that kind of stuff. I love to give a client to say, diligence is going to cost $100,000. Here's why I know it's going to be. These are the reps that we're going to be looking upon. The diligence room has already been set up, right? So the only thing that we're going to be providing to them is going to have my guys go in initially and say, from their perspective, what is missing? But then more so, because they've also populated so much of it, the questions that we go back with are a lot more targeted, okay? It's not like, can you let me know how many NDAs you have with 1,000 different people, which is useless kind of information. You can say, well, we saw this information in here and we saw this NDA, that you put in there, and this seems like it's a non-compete that's baked into this NDA, but if you can, so you ask very targeted questions. That really, I think, helps the sellers on the private equity side, right? To say, oh, is that what you're really trying to ask for? You know what I mean? Instead of them trying to guess, like, let me just give them this information or this information or this information, and such. A deal like anything else, I think it's very process driven. And anything that's process driven comes along with that, momentum. I'm sure, we all bought a car, bought a house or something to that effect. And then you can feel, and that's a real kind of like, you can feel the momentum in that because it's kind of, it's shorter time periods and things of that nature, and a little bit less work. But you take it back 10,000 feet. You're doing the same thing. You're just doing more of it on an LBO or a growth equity investment. And so, I find as though if we can really focus on ways to reduce those costs on that, lawyers, I think, will feel better to provide kind of the value add services. Because I know, and I hope I speak for everyone in my industry, in the sense that we only want to be collecting and billing for things that are true substantive, right? In a purchase price mechanics section, you know what I mean? Where can we help them yield a little bit more protection? You know what I mean? What should be the right thing? One of the benefits, I think I went into transactional law as opposed to litigation, is in transactional law, everyone can be a winner. Everyone can be a winner. You got a seller who now has liquidity, and you have a buyer who actively went out and sought a company that he wanted to buy, or he or she wanted to buy. So, if we all were already starting from that foundation, why are we not doing things, to support that foundation that everybody wins, right? Making things a little bit easier for people and things of that nature. One area I think litigation has been one, you get a list of all these litigation and it's like pulling teeth. It's kind of, it is what it is, guy. You know what I mean? It is what it is. I just kind of want to know what it is right now. I know that you can't tell me, what the exact amount of what the judge is going to, determine, or the jury is going to determine what the settlement is, and that's the settlement of what the actual, ruling is, but if you give us the information, we can make that assessment ourselves and have discussions with you about it. You know what I mean? So I think people being a little bit more forthcoming, I think would, be better served, because I think you're given the opportunity of the benefit of the doubt earlier on in the process. It's human nature, right? You've been doing a deal for 2-3 months with somebody, and then something pops up. That doesn't really leaves a bad feeling to the buyer who's involved. I know we've had that happen to a number of times, and puts into question, what else is going to be coming up, right? So I think, both from a cost perspective, but also from a deal momentum perspective, in terms of how deals can get done, can be, I think could be materially improved. I know everybody's busy, right? And we're just trying to, just do the goodest job as we did before, right? But I think anytime we've had the opportunity to really take a step back and think through these things, in the long run, unlike maybe my other partners when they, they're maybe in their late 50s or 60s, in my early 40s. So I expect to be doing this for a good 25 more years at the very least. And during those 25 years, I hope to see this development, because I know it's been done back a long time ago, but, and I know it takes a huge amount of effort, because you have so many different perspectives, from different law firms and things of that nature. But if that is the case, I always say to the other side, then why does this document look the same as the other document that I have in my other binder? I know you might have a different, perception of it, but the reality is the reality. This is kind of where we're going to land on things, right? And there are things around the margins, things at the end of the day, but this is an area in which I think lawyers can really kind of step up. And at the end of, and as we think about this, the law firm model is changing in the sense, right? Clients are the whole billable model, and to say, oh, it's, I see that changing as well too, right? Where we go to more project-based, scope-based things like accounting firms do, right? And I'm not a person that's opposed to that. I know a lot of people are, right? But we should be able to, scope things out and get to a certain amount of budget, right? And of course, there's gonna be some toggles, things pop up in a deal, right? that adjusts the scope and the budget. But I think with these type of administrative savings, it's going to really allow us to really shift onto what I think the next phase of attorney billing style is going to be, right? It's only going to help that a little bit more, and then give us a lot more longevity in our careers. And then we start really acting as true partners to our clients. I hear the statement all the time. I'm a true partner to you guys. I'll work with you guys and things of that nature. But at the end of the day, we help them on bills, and things of whatnot. But wouldn't they be better served as an industry in which we can set up these certain type of I'll say boilerplate things subject to adjustments, reps and warranties, and other things of that nature, that our people can start focusing on things that are really important, right? I mean, we can talk about what's in net working capital, what's out of net working capital, things that are real kind of business issues that we should really be focusing on. I can tell you from my perspective, on my business issues list, there may be 1 or 2 questions on the reps and warranties, right? What your position is. At the end of the day, the lawyer should know more about what should be in that rep and warranty. You've done the diligence, and you're going to ask your clients a few questions. The only thing that you're going to really ask your clients, I think, on some of these things is, number one, what do you consider to be the top 10 customers? What are the best, top 10 suppliers? Something that they might have done in their own diligence, and things that might be worried about or need to be concerned about, but it also reduces the amount of time you need to speak to your clients about certain things, right? Because we can just talk about the 5 or 6 issues that are really important. This is all in the vein of reducing costs. But I think it's not just a cost reduction thing. It's about having a seamless deal that has the right amount of momentum, right? In which you could have some certainty that deal will happen, within, less than 3 months, right? Because for a lawyer, a deal that passed longer than 3 months, every month just adds more and more to the bill. But I wouldn't say it adds more and more substance, right? Things are just kind of going back and forth and back and forth. So it also reduces the back and forth in the purchase agreements and things. One thing I also will add to, and this is one of my other things, is in an auction process, I don't particularly understand why sellers need a full markup of a purchase agreement. Never fully understood it. Okay. The only thing that I can say is that it reflects that you have committed, fees, you've spent some cost on this, so you must be interested in this, right? And which I think is really, at the end of the day, is that really going to be the case? You know what I mean? Like, just because you had your lawyers prepare a full markup on something, I don't think really reflects how much commitment you have. So, 1 or 2 things that have been coming out, which I think is great, are these grids, right? These are the 15 issues that we consider most to be. So they've already told us, these are the 15 things that we care about. Give us your responses to X, Y, and Z. You know what I mean? So then you've also kind of reduced the cost for people to make bids. It's only better for the seller, right? The more bids you get, the better, right? Then you're able to kind of, right? And then even better than that, you truly can do an apples to apples comparison, because you've controlled the apples, right? You've controlled the, what you're putting out there. So, that's one thing I've seen, lately become more prevalent here in the US. Also, preparing comment memos should be equally as good, right? At the end of the day, the sellers and the bankers should understand what are the big points you're talking about. Do they really need to read the whole purchase agreement and then pull out what those issues are when you could just tell them, right? So it's really, small things like that, I just never really understood. I mean, I think, like I said, the only thing I could, and I know this to be the case because I've been told it shows your level of commitment. But, at the end of the day, shouldn't your price tell you level of commitment?
Yeah,
right?
that's true. If you're bidding at the level and you understand your industry, then that should demonstrate to that. Do you see a major part that PE firms, particularly when they're doing their acquisition process of a portfolio company, let's say, might be family owned previously. Do you see areas of that get missed that then have to come up later, which if they were, upfront with maybe a template, when you require this, we require that, we require all of this. Yeah. Do you see maybe areas that, look, guys, really just start bringing this in and asking for it early doors, because it's just having that communication backwards and forwards just costing you money?
Yeah, no, it definitely, you raised a really good context here. You know what I mean? With founders, I think when you're dealing with companies, you're dealing with founders, they have a lot more trepidation to kind of release certain things of that nature. And And I think one thing that we really want to show them, and because I'm on a certain sell side engagement now in dealing with the founder, and the question that he always asked me, in the individual, he's 72 years old, and he's like, this is annoying. They're just asking for everything. Like, I feel like it's a proctology exam. You know what I mean? And I said, yeah, it is. I mean, you're selling a company. You're selling a company that you've been running by yourself for 50 years. Okay. I know you built this when you're in your 20s, but no one else knows what's going on inside this company. You know what I mean? Except your lenders and people that have worked with you for that many of time. So you have to appreciate the fact that, one, they don't have that legacy knowledge that you have, right? So they need to ask these questions. But I think the more coaching you do, and then one thing that I've done is to say, what do I know that people are going to ask? And then, instead of him getting asked that question by the buyers, I'll sit down with them and I'll say, let's go through these 20 questions. What's going to be your response on these things? And what's been really, really been useful is that we've actually taken those question and answers and populated them into specific sections in the data room, right? You know what I mean? Like, I know they're going to ask questions about, have you paid your sales tax in all these different states? You know what I mean? Right up front, I'll put a note saying that, we have paid all sales taxes in all states and things of that nature. Or these are the states that we have not done so. These are the corrective actions that we're taking, you know what I mean? So just getting in front of that, so I think he found it annoying coming from the buyers, but coming from his counsel, and I'm explaining to him why, just so you don't get frustrated, because you're all getting frustrated by, the questions they're asking right now. Why don't we go through these 20 questions that I think are the most important, and I'll go through them with you, and we'll prepare answers. And then the rest we can handle, through calls and all the things that, like, it really does quell them to say, it really quells their concerns in the sense that, like, these people are not just trying to come here and take all my information and, do all these things, right? Big bad private equity, as they kind of say. And then one of the things I always say to them is, like, that's why you hired me, right? Because I represent most of the time. I know what they're looking for, right? So even though you're saying that I don't want to disclose this right now, I behoove you to just, maybe just raise the issue. So it's not the first time you're telling it to them, because I can guarantee you it's going to cost you a lot more when we have to deal with this later. It's going to cost you in both places. Number one, in purchase price, and two, my fees, right? And those two equal together, it's just a double whammy.
That's very, very honest. Certainly a very honest approach from yourself on that. So bringing this back to talent, which is my kind of favorite subject. What are your, you speak to founders, speak to private equity investors, all sorts of people on both sides of the table. What are your perceptions of the three attributes that make a top performing individual and a high performing person?
Yeah, I guess number one, I think, is your approach and how you go and speak to these founders, right? And one of the things I think, and I'll tell you the attribute in a second, is that I found that people have come in and I've sat down with them. I just came back from a business development trip in Pittsburgh with one of my clients, and I sat down with them a couple of these meetings, meeting new people for the first time, and I was extremely impressed in the sense that they live in a different world, and they live in New York City. They live in, these really nice apartments, and they do all these things, But one of the greatest things about it is that when they're going out and they're speaking to companies, they're very down to earth and genuine, right? That's an attribute I think that people gets overlooked so quickly, right? It's establishing are people those that can establish a very strong relationship, with that founder or seller, from whatever respect, at a very early stage. When it's going from a sponsor to sponsor trade, that's equally been the same, right? Have you worked with these people before? You know what I mean? How you back channel that, and to know, so one of the things I think, your reputation is key, right? Are you the type of firm that makes an offer and then just changes the price always, right? I found that there's a lot less people that they used to do that. When I started my career in 2004, I remember there were a number of funds that you just kind of wanted to avoid, saying that, oh yeah, 100 million, all of a sudden, do the deal, it's like 35 million, but they've kept you warm, So I think number one, it's your credibility and your reputation and how you approach it, and number two is one of the best things that I actually seen is a person, that doesn't make things combative, right? It makes everything collaborative, right? Really trying to bring in other intermediaries to provide him or her, with the facts that he or she needs to know, but then they have these conversations directly with the other business person, and they really kind of break it down for them to say, this is kind of why I need it and why you need it at the same time to get this deal closed. And the third thing I found is a heavy is a heavy concern, and also getting into the weeds a little bit, with the different advisors, right? People that are just kind of do a perfunctory read of things and just want an executive summary on kind of what the environmental report is. That's great, but I found that, the ones that have been very highly successful in finding really great companies are those that really take those issues to heart and kind of factor that into their models and things. And one thing that I also would like to add, and I think is that I've had the best relationships working with clients, and that I've been very impressed with, and we've always gotten their deals done very efficiently, are those that share their model with their lawyers, right? I think any private equity attorney now, in my vintage here, should understand models, right? Our clients' models, you know what I mean? So then it allows me to know if you put in a 20% cushion here for a tax shield, I got some room to work with, you know what I mean? There might be some things that I might be willing just to give up, understanding the fact that you got this tax shield here, and you've kind of made a very conservative tax shield, so it's funds that, that really bring in the lawyers from the business side of things. It also reduces the amount of questions I do need to ask, right? I'm not calling, the MD being like, hey, can we do this? I'll probably just shoot an email. Hey, I saw that there's a 20% cushion here. We're talking about a $50,000 risk over 5 years. You know what I mean? It doesn't move 2% of the needle on your cushion, yes or no, right? So from their perspective, they've seen that, the model, that the risk, you've quantified the risk, you've taken a position on it, and you're saying, just tell me yes or no, because at the end of the day, it is a business call, you know what I mean? But from them, it creates a lot of efficiencies, right? As opposed to having to explain this issue to them, right? Because they were not so involved, you know what I mean? It's kind of explain, it just creates a lot more kind of noise, in order to get to the right answer.
Perfect. And we talked at the start about your affliction to private equity, having a winner on both sides, with it being M&A, and that was your attraction to that. But what do you love about the private equity industry, and equally, what do you hate? And if hate's too much of a strong word, because I appreciate you're a supplier to the industry, what do you dislike about it?
And maybe I'll make this question, and maybe it's not, it's appropriate. You might want to, maybe it's not appropriate for other people, but I think, one of the things about private equity that, to me, and this is personal to me, is I have yet to find any other industry in which the American dream, as we call it here, can be achieved, right? Private equity opens an opportunity for someone like myself that came from very humble beginnings. We immigrated to the United States when I was very young. We didn't live in the greatest neighborhoods and, whatnot. And went to law school like everyone else, have all these, these law school bills and, whatever. But private equity is given the opportunity for someone like myself that maybe never had access to people like that run private equity firms, and access, for them to, in my generation, be able to have a modicum of success here that I just don't see in other industries, right? Like, by way of example, like, with IP, intellectual property, I haven't seen anyone say like, this has really just changed my life in a certain way. I know there are many of my colleagues, that are very similar to me, where, maybe they come from very humble beginnings here. And by no means are we saying that, that we're Buffett, but we're better off than our parents were when they got here. So for number one, for me, private equity is always going to be very special to me, because in a sense, it gave me an opportunity and many others like myself. And that's why I'm really, ESG to me is a very big, important thing to me. And that's why I think it really fits well into private equity. in the sense that, if private equity looked at themselves, and we get a lot of slack, and some things rightfully so. But one thing I think that's always overlooked is how many people that are serving as managing directors, of private equity funds that have gone out and started out their own funds, are people that were just like me from a very, lower middle class, or something to that nature, you know what I mean? Or are diverse, right? You know what I mean? As you can see, I'm Korean, you know what I mean? But if you go to any fund, you'll see, they're extremely diverse, you know what I mean? One by way of example, Stellix Capital is a client, and if you saw their roster, I mean, it's one of the most diverse, balance of women, male, different minorities, and things of that nature. So for me, I think that's, the biggest benefit, the things that I love about private equity is that it's really given an opportunity to a generation of people, and it's continuing for the next generation of people to provide them with an opportunity to succeed in a way that many of us, I think, we never thought this would have been possible, right? I always say this: I'm playing with house's money, because I just feel so grateful and fortunate. One of the things, on the other side is, say what's bad or what can be, maybe I'll change that, say, what can be improved in private equity. I think it's also equally what I just said now, it gives us the access, but I think, one thing that private equity can do is, and I think it's a little selfish, and I'm speaking very selfish on my part, and I'll just admit that up front, is, granting people with, that are minorities, just a broader access to a larger set of clients. You know what I mean? While we do get access, to the clients that we do have, but getting new opportunities from other people, you know what I mean? To show that, a diverse, a diverse attorney could really, could really just also add a different perspective in how you're looking at deals and things of that nature. So, if there's one thing that can improve, it would be more of that. I think, we've gotten the great access, and I think it's really expanding the access, there as well. But like anything else, it has drastically improved, right? I mean, sitting here in my office now in Proskauer, and thinking back, and that's one thing I did on my drive in this morning, and when I was getting ready for this, is like, how did I end up here, right? Like, how did this happen, right? And it really goes back to, I have two mentors that really took an interest in me, and they were, both they're not minorities, right? You know what I mean? They took an interest in me, and private equity has also that aspect to it, in the sense that you find mentors, and you find that a lot of people that go from different shop to a different shop, they're kind of hooking up with people they were with before, right? So it becomes very, it becomes very collegial, in the sense, collegial. So, but at the same time, like I said, we want to just broaden the access out to more people, to give other opportunities. And I think, private equity funds to say, listen, we want to be working with, diverse teams or things of that nature, to help them, with their ESG compliance. I really want them to understand that it's not the ask not here is to say, I'm Asian, so you should hire me. That's not the play. I'm saying hire, or at least give someone like us a chance, because you might be experiencing a different type, a work experience than you might otherwise think. For me, I've had to always think about, in ways how to reduce the fat, how to make processes better, and things of that nature. I don't think, I know there are other people that think about what I do, but I don't think everybody does, right? And so it's really giving people a different experience on these things, just to say, hey, so because something is different doesn't mean it can't be same or better.
No, I love it. And I think that's a fantastic advert for private equity. I don't think I could have put that better myself, but it's great that it does give such a diverse opportunity, and it helps, huge supply chains of the company you're acquiring, that supports the local economy. And, you mentioned it earlier with regards to some of these businesses that transform towns, transform cities because of the, what they bring to the table as they grow and as they develop, and you don't think of it as suppliers into the actual private equity industry and the opportunities that brings. But I think that's a really great advert, and also an area that the industry can continue to improve. And there's a real need for it to do, and there's a want for this industry to want to improve and to change and to bring different ideas and different aspects and create that diverse, certainly that diverse environment. So obviously as a lawyer, as an attorney, you have to, keep up to date with things, and, continuous CPD is going to be a key area for you. But outside of that, kind of, where do you get your influences from? What do you read? What do you watch? What do you kind of listen to?
For me, I think, I actually do focus more on industry news and things of that nature, right? So like I'm focused in industrial, so I read a lot of the industrial trade magazines and things of that nature. Because, for me, you want to be ahead of things as opposed to kind of learning. But by the time it gets to a law trade, you know what I mean? Someone's already done it. Someone's already, been there and done that. So, for example, I'll kind of go back to ESG here. And, the kind of the research that I do around ESG is not what other law firms are writing. What are the banks doing here? What are these different organizations? So I really, do that. The other thing I do, I'm also involved in different, kind of small think groups, that I've signed up for as well too. I'm signed up to 4 different ESG, different groups. I just signed up today, to join the LSTA, working group on ESG concepts. The LSTA is kind of the model form for credit agreements and such here in the US and such. So I really tried to get myself involved more on the ground on some of these things because it's such kind of the early stages of this. I want to kind of grow with it, in terms of other influences, in terms of, what I do, I do really look at the government a lot and to see kind of, how they're acting. And, of course, you got to follow those type of regulations and such. But it's been really, it's always been very, I won't say the word shocking because I'm not shocked. It's really always been a question to me to see the, how much of an impact a change in government, from president to president, does. So a lot of my focus has been kind of focused recently more on, what Joe Biden here is doing, things of that nature. But otherwise, I think other influences, and it shouldn't be, short-sighted. I think it's in the sense of, what else do I, read and watch and things, I actually, I usually watch all different news, right? CNN, Fox, you know what I mean? Because just to get a different perspective on all this stuff. And it allows you to make your own decisions on these things. But at the same time, you have to also take a step back and, enjoy yourself a little bit and also take some things out of that. And, for me, watching a lot of sports but the business around sports, right? It's like a little microcosm of private equity in itself. You got all these little fiefdoms and other things of that nature. So it's really been really great one. I also do a lot of books on read a lot of books on leadership. General McChrystal, wrote a book on leadership here, and that's kind of usually one of the books I try to read. Because you'd be surprised in terms of the things I've been talking about today. Many of those principles have come from these books on leadership, right? Because leadership, it also doesn't mean it just, are you the guy out in front? No, it's, are you the guy that's really going to be stepping up first and to say, this is important. So, I'm actually going to do something about it, right? And that's what really propelled me to the ESG stuff. I know this is important. Am I going to ride someone's coattails on this? Or am I going to be someone, in the beginning to really, have my voice and to say, and help shape these things? Because it's only going to impact my, just my career going for the next 5, 10, 20 years. But, when you look back on this stuff, we're doing all this stuff because at the end of the day, it's also my children. I have a 7, 10-year-old, and what's the world going to look like for them? One of the biggest things is, one thing I do is I'm very involved in women diversity issues because, having 2 young daughters changes your perspectives on a lot of different things. And one of the things that really has changed the way I've done things in the last about 10 years is to always ensure that I have a female person, be a lead associate or lead counsel on all my deals, right? Just to kind of show, there are things like that I do that I really kind of, dive into, I think, what I think is important now for me.
Excellent. So if anybody is listening to this, James, wants to reach out to you and connect, how best do they do that, please?
Yeah, sure. I mean, I can be easily reached at my email address, which is jclee@proskauer.com. That's proskauer.com. Or you can feel free to call me at 212-969-3036.
Perfect. We'll put that all in the show notes for anybody who didn't quite catch that. But James, thank you very much for joining us today. I really appreciate your insight. You've left with lots of value that both private equity professionals and portfolio execs can action immediately. So that's been perfect. Thank you very much.
I really appreciate the opportunity again. Thank you.
And as always, thank you very much to everyone who's listening today. Should you ever need support with private equity professionals or portfolio executive hiring, then please do reach out to me at Raw Selection. And if you haven't already, please do subscribe and you will be notified of the next podcast, which comes out every 2 weeks. But till then, please do keep smashing it.
Thank you for listening to the Private Equity Podcast on www.raw-selection.com.